Financial crises, they aren't just some abstract headline you scroll past. They have real-world consequences that can shake up everything from your savings to the entire job market. So today, we're going to tear down why they happen, and we're going to look at the global rulebook that's supposed to stop them from happening in the first place. Let's dive in.
Okay, so what is the connection between a tech-focused bank in California and a massive historic bank in Switzerland? It sounds like the start of a bad joke, right? But in early 2023, this wasn't a joke, it was a global headline. And the answer, well, it tells us something really critical about our financial system. Everything is connected, and maybe, just maybe, it's a little more fragile than we like to think. A single failure can spark a worldwide panic in just a matter of hours. So how did this all go down?
It happened so fast. Unbelievably fast. In March, Silicon Valley Bank, a darling of the tech world, just collapsed. Days later, boom, Signature Bank was gone too. And then the panic literally jumped across the Atlantic, forcing this massive emergency rescue of Credit Suisse, a pillar of Swiss banking. And it wasn't over. By May, another big U.S. bank, First Republic, had also failed. The speed was just breathtaking, and it proved that in today's world, financial panic doesn't care about geography.
Now, look at this number, 89%. This right here is what made the situation at Silicon Valley Bank a ticking time bomb. A staggering 89% of their deposits were uninsured. That means they were way over the government's protection limit. So for these depositors, we're talking tech companies with huge amounts of cash. Any hint of trouble meant one thing and one thing only. Get your money out. Get it out now. That, my friends, is the very definition of a bank run.
So you see, this wasn't just about one bad bank. It was a perfect storm. To fight inflation, central banks have been hiking interest rates like crazy. Now, why does that matter? Well, when new bonds are issued with higher interest, all those older, lower interest bonds that banks were holding, they suddenly became worth a lot less. This created these huge, hidden losses on their books. You combine that weakness with all those uninsured deposits, some seriously flawed risk management, and the power of a digital bank run, and you get a crisis that spreads like wildfire. And here's the thing, the really crucial insight. While the 2023 crisis felt super modern, driven by tech and social media, its root causes are as old as time. Financial meltdowns, it turns out, tend to follow a very familiar pattern. It's almost like there's a recurring recipe for disaster. Let's break down those ingredients.
You can almost see the pattern laid out right here. It usually kicks off with a credit boom. Everybody's lending and borrowing, which inflates a big asset bubble. Then you add a key vulnerability, something like a maturity mismatch. That's where banks are using short-term money, like our deposits, to fund long-term loans. If you don't have strong capital cushions to absorb losses, or good regulators spotting the risks, the whole system just gets incredibly fragile. Then all it takes is one little shock, and boom, contagion spreads through the whole interconnected system.
So if this is a danger that keeps coming back, who's policing the system? Well, let's meet the global firefighters. These are the international groups whose whole job is to prevent these crises and to put out the fires when they inevitably start.
It's really a team effort. You've got the Basel Committee, the BCBS. They write the global rulebook for how much cash banks need to have on hand. Then there's the Financial Stability Board, or FSB. They're like the lookouts, worrying about risks to the entire system. The IMF, they act as a sort of global lender of last resort for countries that get into deep trouble. And then, crucially, you have the national supervisors. They're the boots on the ground, the ones who actually have to implement and enforce all these rules.
Okay, one of the most important tools we got from the ashes of the 2008 crisis is something called the liquidity coverage ratio, or LCR. Think of it like a really simple but powerful rule. A bank it must, hold enough high-quality, easy-to-sell assets to survive a 30-day full-blown panic, all on its own, no bailout needed. It's a mandatory cash cushion, and it's designed to stop a little scare from becoming a total collapse.
Regulators basically look at risk through two different lenses. The first is macroprudential. That's all about the health of individual banks, making sure each tree in the forest is strong. But then there's macroprudential regulation. That's about looking at the entire forest, worrying about those big systemic risks that can bring everything crashing down.
And to be effective, you absolutely need both. But here's where it gets tricky. Regulating the financial system isn't black and white. See, the goal isn't to get rid of all risk, because a system with zero risk would also have zero economic growth. And this creates this fundamental tension, this constant balancing act that we call the regulator's dilemma.
This chart just captures that trade-off perfectly. On the one hand, you make the rules tighter. That gives you a safer, more resilient system, but it can also choke off lending and slow down the economy. On the other hand, you could loosen the rules. That can fuel a booming economy, but it dramatically increases the risk of a catastrophic crash. Finding that sweet spot, that perfect balance, that's the billion-dollar question for every policymaker.
And of course, even with the best rulebook in the world, you run into real-world limits. Rules that everyone agrees on internationally might get watered down or just plain ignored by some countries. Risky stuff often just moves into the shadows, outside the view of the main regulators. And let's be honest, the system is so complex that sometimes the models we use to measure risk can just be flat out wrong.
Okay, so after going through the anatomy of a crisis and the regulator's big dilemma, what are the key takeaways here? For anyone studying finance or just trying to understand how this all works, what are the lessons we really need to hang on to?
First, and this is probably the most important thing to remember, resist the temptation to find a single villain. Financial crises are almost never the fault of one person or one bank. They're the result of a ton of different factors: the economy, bad incentives, gaps in the rules, and just plain old human behavior, all mixing together in really unpredictable ways.
And the second big lesson is that you need the full toolkit. It is not enough to just make sure individual firms are healthy. That's the micro, save the trees view. You also have to have tools to manage the risks across the whole system, like those big credit bubbles. That's the macro, save the forest view. If you only focus on one, you're leaving yourself dangerously exposed.
This quote from our source material really just says it all. The job of managing financial risk is never, ever done. Just when you think you figured out how to prevent the last crisis, financial innovation creates some new product, or globalization creates a new connection that changes the whole risk landscape. Constant vigilance, that is the name of the game.
And that brings us to our final, and maybe most important question. With innovation moving at light speed, from crypto to AI constantly reshaping finance, the rulebook is always playing catch-up. So we have to keep asking ourselves, while we're so focused on fighting yesterday's battles, is the next big crisis already quietly brewing in a new blind spot we're not even looking at? Thanks for watching.